The broker has a pitch. Now you get a CPA. There's a business listed for $380,000. The broker tells you it earns $120,000 a year. The numbers check out on the summary sheet and everything looks solid. Here's what you don't know yet. That $120,000 figure was built using a formula, and inside that formula are numbers the seller chose. That's right. Not audited, not verified, chosen. By the time most buyers figure that out, they've already emotionally attached themselves to the deal. They've already imagined themselves running it. And they're about to write a check based on a number that was never independently verified by anyone whose job it is to protect them. I'm going to show you exactly how that happens and exactly how to stop it. Hi, I'm Jason Schmidt, a CPA. In this series, I'm walking through every financial trap that costs business buyers under $500,000 their savings, their credit, and sometimes a lot more than that. In the last video, we talked about what brokers aren't required to tell you. This video is about the one number that determines whether any business is actually worth buying and how sellers make it look better than it is. The number you need to understand is called Seller Discretionary Earnings, or SDE. SDE is supposed to represent the total financial benefit to a single owner operator of a business. In theory, that answers one question. If you bought this business and ran it yourself full time, how much money would you actually take home in a year? Here's the formula, all right? SDE is equal to net profit plus owner's salary plus personal add backs plus non-cash expenses. Okay, we're going to break that down piece by piece. Net profit is what's after the business pays all its operating expenses. That is your starting point. Owner's salary gets added back because when you buy a business, you become the owner. You'll pay yourself, so it shouldn't count against the earnings. Non-cash expenses, that's mainly depreciation. It gets added back because it's an accounting entry. It's not actual cash leaving the business. So far, so good, right? Those add backs are legitimate and pretty much standard. The problem is the fourth category, personal add backs. These are personal expenses the owner ran through the business, such as cell phone, a vehicle, miles, meals, travel. Sometimes a family member's on the payroll who actually doesn't work in the business. When they're legitimate and documented, that's great. Add them back. But here's the reality. There's no legal requirement for those add backs to be independently verified before a business goes to market. The seller reports them. The broker uses them to calculate SDE, and the asking price gets built on a number nobody has actually audited. Let me show you what this really looks like in real life. The laundromat has $40,000 worth of net profit on the books. The owner pays himself $50,000. Standard so far, right? SDE is $90,000. Now that's before we even touch the add backs. Now the owner adds back $15,000 in expenses for his vehicle, $8,000 in meals and entertainment, $6,000 for a plan, a cell phone plan that covers his entire family, and $10,000 for a relative listed as an employee who helps out occasionally. Okay, that's $39,000 in add backs. Okay, suddenly the SDE now is $129,000, not the $90,000. The broker applies the standard 2.5 times multiple for a laundromat. The asking price now is $322,500. Okay, now ask yourself, what is the business actually worth if those add backs were $15,000 instead of $30,000? What if the vehicle was partially personal and only $5,000 was genuinely business related? What if the family employee wasn't coming back after the sale? At $54,000 real SDE and the same multiple, 2.5 times, gives you net valuation of $135,000. Same business, same listing format, $187,500 difference in what you should actually pay. Now listen, that's not a rounding error. That's the difference between a good investment and a financial disaster. There are two things every buyer should do before accepting any SDE figure as real. Okay? First, request 3 years of tax returns and compare them to the broker's SDE calculation line by line. Tax returns are filed under penalty of perjury. They don't lie the same way a summary sheet does. If the add backs on the broker sheet don't match what's on the tax returns, guess what? You found a big problem. I want to be specific here. You're looking at add backs on the broker sheet that don't appear anywhere on the tax return. If the seller is claiming $15,000 in vehicle add backs and there's no corresponding vehicle expense on his Schedule C, that number became, well, where did it come from? The number came from somewhere creative, right? Second, ask this one question directly to the seller or broker. Can you show me documentation supporting each add back? That question alone will tell you everything. Legitimate add backs, guess what? Have receipts. You have bank statements. It's clear business justification. Inflated add backs get vague answers and slow responses. The quality of the answer to the question tells you more about the deal than any number on that summary sheet. Once SDE is calculated, the asking price is set by multiplying the SDE by an industry multiple. For most businesses under $500,000, the multiple is somewhere between 2 and 3.5. And that depends on the industry, the location, the age of the business, and how transferable it really is. Once SDE is calculated, the asking price is set by multiplying the SDE by industry multiple. For most businesses under $500,000, that multiple is somewhere between 2 and 3.5 times. Depending on the industry, obviously, the location, the age of the business, and how transferable it really is. Laundromats typically trade between 2 and 3 times SDE. Service businesses can vary wildly, and restaurants tend to be lower just because of the risk. Here's the thing nobody tells first-time buyers. That multiple is negotiable, and the multiple should be lower when the business has risk factors. Okay? Old equipment, lower multiple. Lease coming up for renewal. Guess what? Lower multiple. Owner-dependent operations, lower multiple. Business closed for a period of time, significantly lower multiple. Possibly asset valuation only, which we covered in video 1. When a broker quotes you a multiple, your job is not just to accept it. Your job is to justify it. Why does this business specifically deserve a 3 times multiple? What makes it worth that premium over a 2x deal? If the broker can't answer that specifically, the multiple is aspirational and not justified. Here's your takeaway from this video. The next time you see a business listed with an asking price, you now know the price is derived from SDE, and SDE contains add backs that may or may not be real. Your first move is always get the tax returns and compare that to the broker's number. Your second move is to ask for documentation for every add back. And your third move is to question the multiple because it's not fixed. It's negotiated. Now listen, if you want to dig into a specific deal you're looking at right now, bring the numbers into the Firewatch Business Lab on school.com and we can talk about it together there. Next video in the series, I'm walking you through the question your business broker hopes you never ask and why asking them changes the entire dynamic of any negotiation. It's not about finding a deal. It's about avoiding the bad one.